Hello students. Yes, so in my previous video I have explained on what is investment. So far we have covered what's the meaning of investment, what's the purpose of investment. If an investor, it can be an individual, government, industry, when they are moving ahead with making an investment in any kind of project or portfolio, right? It can be purchasing of an asset. All these comes under the term investment. So far we have understood what are the objectives, what are the features of investment, and what are the steps or the process involved under the investment. If an investor has to make, he has to keep two things in mind. One is a risk, another one is a return. Always he should make sure that the investment what he has made, it should meet the factor of safety, it should ensure a liquidity, right? So far we have read all the basics of investment. Now in this video I am going to explain the different marketable securities that which are available in the prevailing Indian market. So basically we have four bifurcations under investment avenues, or which are also called as marketable securities. The first one what we have is money market securities. Second one, the capital market securities. Third one, we have derivatives. And last one, we have indirect investments. So we are going to understand each and every the avenue or the portfolio that which is available in the Indian market. So to start with, the first one what we have is money market securities. See, basically this particular four bifurcated chart, it shows for an investor what are the different portfolios, what are the different avenues available for him to invest money and mint the money out of it, or generate the income out of that investment. Basically if you ask any person, a layman person or an ordinary person, he'll say you can invest in mutual funds. He'll say basic thing is you can invest in the bank, right? It can be in form of issuing preference shares, issue of debentures, issue of equity shares. Apart from that, you have various other the investment avenues or the portfolios which are available for an investor to invest and make money, that is make his money grow on over a certain period of time. All right. To start with, we have money market securities first. First, we should understand what is money market security is all about. See, money market, basically it refers to a section of financial market, where the financial instruments are traded over there, and these financial instruments are short term in nature. I mean to say, here under money market securities, what kind of financial instruments are traded? Financial instruments, those which have the maturity period of just of 1 year or less than that. When these kind of financial instruments are like they have this short term maturity that which are traded, of course it ensures the the factor called a liquidity. Now what does liquidity talk about? How easily you can turn out, how easily you can convert your assets into cash, how easily you can convert your investment into cash, how easily you can sell it and get in the cash. That's what the money market securities focus towards. See, the money market has become a component of the financial market in order to trade, that is buying and selling of securities which are of a short term in maturities. All right, so like it can be of a 1 year or a less than that. Fine. So this talks about money market securities. Now under money market securities, we have few examples. Let us understand each example, who is going to issue, what's the objective of that particular the avenue or the portfolio, what's the risk factor associated with that, and what is the maturity period. Fine. So the first example what we have as a money market financial instrument is Treasury Bills. Now, what does Treasury Bills talk about? See, the treasury bills, they are also called as T-bills, right? So again, treasury bills are the money market instruments, and who is going to issue it now? It is issued by the government of India. Treasury bills, they are also called as T-bills. T stands for treasury. Fine. In short form, it is also called as T-bills. They are one of the market instruments which are traded under money market securities, and they are issued by the government of India, and which acts as a promissory note. Where, see here, it's because the government is interviewing with this particular aspect. Of course, there is a guaranteed repayment of whatever you have invested, that is at a later date, and they are always issued at a discount to the published, the nominal value of the government security. So basically what you have to understand about treasury bills is that they are the T-bills which are short term, the debt instrument which is issued by the government of India, and which is, presently issued in three tenors. Like basically you have three types of T-bills at what time you can present it. One is for 91 days, 182 days, and 364 days. In simple words, the time maturity period is like 3 months, 6 months, and 9 months. Fine. So the treasury bills are like a zero coupon securities, and it pays no interest, right? So how it is even going to happen? So to sum up with, the treasury bills are the instrument which are short term borrowing which is issued by the central government. As I told you, since there is an intervenue of the government in this, of course there is a guaranteed repayment on whatever the investment you have made, you have purchased it. Fine. And they have a maturity of less than 1 year, and of course they are a part of money market in India. Fine. So who is going to issue? Only the central government of India can issue the T-bills, and it is for what good sake, ma'am? For why the government is going to issue it? Why it is going to collect the money? It is because the government wants to manage the short term liquidity. I mean to say, their working capital needs to be achieved. That's the reason, and they have assured the yield, and you can have, what do I say, the negligible risk of default. Why, tell me? It's because there you have government, so you need not worry about the element of risk. Whatever you have, it has issued on what you have paid the price, definitely you will get the interest on that. Fine. And which is issued in the primary auction which is conducted by the Reserve Bank of India, like on behalf of the government, right? And the treasury bills are always issued at the discount and are redeemed at par. Like example, if I have to give, see, if there's an investor where he is going to give, that is the government, it is going to issue the treasury bills for rupees 100. I'll take just a minimal amount for your better understanding. It is going to take a T-bill where it is going to issue for 100 rupees, which is of 91 day, where the maturity period of that particular treasury bill is for 91 days. Even though the issue price, the face value of 100 rupees, the government is going to issue it at 98.20. Listen to me very carefully. Even though the face value of the T-bill is 100 rupees with a maturity period of 91 days, the issue price of that particular treasury bill will be for 98.20. So at the time of maturity period, the investor will be getting rupees 100. That 1.8 will be his interest, what he is going to get it at the time of maturity. Now link with this point, treasury bills, they are always issued at a discount, and they are redeemed at par with that original value itself. And always, the discount rate, or the interest rate, it is a market driven, right? It is always a market driven. Fine. Basically you have three types of T-bills: 91 days, 182 days, and you have it for 364 days. So how these things are going to work? Basically, what happens with that is, the auctions of T-bills, that is treasury bills, it is conducted by whom? RBI. And always the T-bills, they are issued on discount to the face value, as I told, with the example of rupees 100, while the holder gets the face value on the maturity. At the time of maturity, he is going to receive the entire amount, and the return on T-bills is the difference between the issue price and the face value. See, in my example I told the face value is 100 rupees, but RBI is issuing at what price? 98.20. So what's the difference between that? It's 1.20. So that becomes the return for that particular investor who has invested in the treasury bills. I hope I'm clear with this. Fine. So the return or the income on treasury bills, it depends upon the auctions which is going to happen. See, when the liquidity position in the economy is tight, returns are higher, and of course it is vice versa as well, right? So that's how the things are going to work under this particular treasury bills aspect. Fine. So to sum up with this particular concept, what you have to understand is that, what do you mean by treasury bills? Treasury bills are the short term securities which is issued by the government, where there is a guaranteed repayment at a later date. The return what you're going to get is the difference between the face value and the that is the issue price and the face value. Who is going to issue it? Of course, the government is going to issue it. Now you ask me, ma'am, what's the risk factor involved? Of course, it is least risky. Now why do I say least risky? Of course, see, I told you, since there is intervention of government, you need not worry where RBI is involved. So you need not worry about the factor of risk. And what will be the maturity period? You have three types. One is 91 days, 182 days, and 364 days. So basically the maturity period is 3 months, 6 months, and 9 months with respect to the treasury bills. So this talks about the concept of treasury bills, where this is one of the important instrument that which is traded in the market under money market securities. Now what you have to understand with the term money market securities, where the financial instruments for short term maturities are traded. Now kindly associated with this particular meaning, so that you will understand the treasury bills very clearly. Money market is where it has become a component in terms of having a trade, that is a buying and selling of securities which is of only the short term maturities. Those instruments that which has the short term maturities of 1 year, or it can be less than 1 year. That gives you an example of treasury bills which matures like three types: 91 days, 182, and 364. Basically 3 months, 6 months, and 9 months. Is it less than 1 year? Of course yes. So definitely this is one of the popular financial instruments under money market securities, that which ensures the factor of liquidity.